On one side, there's economy, and on the other side, there's stock market. Many people think they are same. If the stock market is performing good, then economy of the country is also doing good. This is the case until it's not. GDP of United States is doing great for the past 50 years. So the S&P 500 is the most popular index on the stock market. This connection becomes clear if we look at the yearly changes in both indicators. Look, there are some years when stock market is way up, but the GDP growth is down than previous year or sometimes negative. Sometimes stock market is not performing so good, but GDP is growing. Why there is disconnection? Logically, we can conclude that stock market cannot fall short of the economy of a country in long term, because the businesses of the companies of those stocks are deeply integrated into the economy. Long-term economic trends reflecting the stock market does make sense, but with some assumptions. This is called a supply-side model. Supply-side model assumes that GDP growth of the underlying economy flows to the shareholders in 3 steps. First, it transforms into corporate profit growth. Second, the aggregate earnings growth translates into earnings per share growth. And finally, earnings per share growth translates into stock price increases. This is only true when we assume that the share of the listed company profits in the total economy or GDP remains constant. And also, the stock market of the country only lists domestic companies, and with some other more technical assumptions. This theory perfectly depicts the combination of stock market reflecting the economy. But this argument can be considered as vulnerable if we apply these assumptions to real life, as most of them does not hold true. First, economic globalization has some major effects on different economies. A company from maybe Spain is listed on the US stock exchange and primarily earns revenue from United States. But those all profits are going into the pockets of Spain if Spanish investors hold majority of those shares. It's growing Spain's GDP more than US. Taiwan Semiconductor Manufacturing Company, TSMC, is a good example of this situation. It is primarily listed on New York Stock Exchange. TSMC holds good amount of weight in United States, but its connection with US GDP is somewhat questionable. Another logical factor here is that the companies listed on the stock exchanges are only the tiny portion of business activity in the whole economy. In case of United States, 99.9% of all businesses are small and medium enterprises. Only 0.1% are big and mostly listed on stock exchanges. Thus, a small portion of economic activity cannot certainly tell the position of economy. Another factor which is kind of relevant is we often measure stock market in terms of indexes, like S&P 500, which tracks the biggest 500 companies in all stock exchanges in United States, or Russell 2000, which tracks top 2000 smart companies. When someone says S&P 500 is up 2% this month, then we can clearly say that stock market is doing great. But this index is pretty much a fraction of total stock market. And also this index contains a bigger portion of just few companies. So if just these companies are doing well, then the index will be pumped up pretty much. And generally we can say stock market is doing good. Our real life case can be the time like we are aiming. Yeah. Since pandemic, a lot has changed. And if we specifically talk about 2020, then the GDP of the United States contracted by almost 3.7% in 2020 just alone. Unemployment rates was up and the economy was pretty much in an outgoing phase. Although it is still now, but in the same time, S&P 500 was up by almost 16%. Yeah, in 2020 just alone. Why? A lot of people were at home consuming digital content and exploring different opportunities while they had free time. This led to a higher demand of products from tech companies, and you know that the tech companies make a bigger portion of this index. So stocks pumped up due to good future prospects. And also due to the free money people got in the names of stimulus checks. They gambled this money in stock market and it really pumped up the valuation of different companies. And other element which I think needs to be included in this analysis, which is the most prominent property of the stock market, predicting future. The current valuation of stock market is highly dependent on the investor's sentiment about the future of economy. If people think that the economic conditions will be helpful towards the businesses on the stock market, then they invest in stocks. Sometimes this leads to stock bubbles, like in the case of Japan. Nikkei index of Japan was booming in the late 1980s, but this bubble busted and this index remained flat until recently when it again reached same point where it actually busted 35 years ago. But meanwhile, GDP of Japan was growing. Commonly, there was a dip in the stock market when GDP has peaked in years. This is the ultimate form of disconnection between economy and the stock market. I hope you guys like this video, and if you got some valuable information out of this video, then don't forget to show some support. Bye.